Hey guys, welcome back to my channel. It's been a bit of time since I last made a video, but if you like this one, hit like and subscribe and so forth, and I'll see if I can make some more. So Lemonade Q3 2024 numbers just hit, and I'm filming this video before the conference call. So just some really high level quick thoughts from me. Headline numbers are really good. So loss ratio, which has been the big talking point for the last probably 2 years for this company, is down year on year, and also down sequentially 5 quarters in a row. So that is a really nice trend to see, down to 73%. And it is really worth noting and emphasizing that that has happened in a quarter where many people would have expected Lemonade to show a pretty bad cat number, because we had those 2 big hurricanes, and seasonally Q3 is a really bad quarter for cats. So to post a 73% loss ratio is really good and very encouraging to me. Customer count up to 2.3 million. Of course, we expected this, that in Q3 the company aggressively goes after new customers, and so we've seen those customers kind of come in, and really nice to see the pet number going up. So I'll come to the breakdowns later on, but pet is up to 254 million in-force premium. Really great. And you'll have seen my previous pet video, where I believe that pet is going to be the single #1 driver of profitability, just on a ratios perspective, and I've talked about that before. Net cash flow in the quarter, positive 48 million, like outstanding. That is really, really encouraging. Of course, we know that the company is using the synthetic agents program to onboard new customers, and that will of course result in a payback to the synthetic agents company. But the way I see it, and we'll talk about the growth spend in a minute, but the way I see Lemonade is that they have a core business where they have this block of customers, and that's going along. And as they are making gross profits, they're reinvesting those gross profits into acquiring customers. And I often find it quite helpful to think about Lemonade, just for my own thinking, to consider if Lemonade was a different type of business, how would we look at the numbers, right? So if Lemonade was a used car dealership, let's say they bought 1,000 cars and sold 1,000 cars in a given quarter over time, and they made X amount of profit. But then let's say they wanted to grow the business, and they took a load of that profit that they were making, and then they reinvested it into buying more inventory. That would clearly impact short-term profitability depending on the accounting methods used, but the longer term profits would be greater because they're purchasing more stock that they will sell for profits later on. So I think of it in those terms, like, don't focus on the insurance business, but think of it in a bigger context. So cat diversification. So this was one that I've really been looking for over the last probably 18 months, and shout out to Neil. We had a lot of discussions on this probably over a year ago. Well, I had genuine concerns about Lemonade's ability to survive a significant cat season. So my concern was, let's say the home portfolio was 25 or more, probably quite a bit more at that time of the portfolio, and Lemonade had a really bad set of catastrophes. I had genuine concerns about their ability to survive, and we had a big discussion. Daniel Schreiber also got involved when Neil put this question to him, and he said no, we've got adequacy and so on. I had doubts, and those doubts are fully out of the way now. Like, when you look at the 2 hurricanes that came in Q3, we would have expected some damage to the cat number, but it's just not there. We've got a 73% gross loss ratio, and really interesting to see that Lemonade actually called this out in the Q3 letter and said, if we had not diversified and kind of moved away from the heavy focus on home, the gross loss ratio would have been 40% higher. Now imagine if we had woken up or we'd looked at those numbers and they came out yesterday, and instead of 73, you had 113% gross loss ratio. Like, the stock would be $8 right now, or it'd be a really bad result. And so the team have taken on board, I think, feedback from the investor community, maybe from like the chief underwriting officer, the chief insurance officer, like they've taken on board and like used their brains and looked at actually what happens in a bad quarter. Can I afford that? No. And so really encouraging to see that. That was a real game changer for me to see that Lemonade have significantly de-risked the portfolio and moved into lower volatility products. Really good to see. Again, something else that we've talked about, I guess, on the spaces that we used to have, we kept talking about this, and I guess in the earnings letters as well, the team talked about the lag between like seeing how products are performing, seeing losses come through, realizing you have to raise rates, and filing rates with regulators, and then waiting for those new rates to earn through. That was a big cycle, right? And I talked about it before on my board, where you've got these time differences. And again, the guys are kind of speaking to that in this quarter, but also confirming that rates are coming online. More and more products are becoming rate adequate. So we should see, I think it's very predictable that the loss ratio will continue to come down over coming quarters. I don't know where the floor is. I don't know where the guys would want to cap that. If your loss ratio becomes too low, that means that you're just writing at too high prices, right? So if your prices are too high, clearly you're going to acquire less customers and grow less quickly. So there will be a sweet spot. I suspect it's about 65 to 70%. But interesting to see where that plays out. I think actually Renters is probably already performing at an extremely low loss ratio. I think it might be like 35-40%. We don't have that breakdown for this quarter. Yeah, so loss ratio steadily declining. That to me again is a really positive and easy thing to look at. Like growth numbers, customer numbers, etc., all can move around, right? You can spend 10 million more, acquire more customers, get a higher growth number. Loss ratios are much harder to manipulate than many of the other metrics. Like growth numbers and so on are easy to fiddle. Loss ratio is very difficult to fiddle because also it takes a long time to move a loss ratio. It takes some systemic, like focused attention on different parts of the business to have loss ratios in a good place. So really great to see that. Operating leverage, Paperback has spoken extensively to this, so I won't go too deep. But again, like we saw the chart. Again, no need to really draw this out much because it's in the actual earnings deck, but the expenses are actually flat. Sorry, I've drawn that wrong, but the expenses are flat over time, excluding the growth spend, and revenue is doing this. So you don't have to be a genius. I'll just come in a bit. You don't have to be a genius to figure out that if revenue is going up like this, and expenses are staying flat, ultimately you're going to see some big profits come in. So really, actually while I'm on the board here, I just want to talk a bit about PPD, which is prior period development, because it's in the letter and it's been broken out by quarter. And I've wanted to touch on this for a while, and I think it will be useful to explain to the audience. So I need an example. So let's think of a special kind of insurance company, right? I'll just put the camera back here. Special kind of insurance company that sells a special insurance product to do with football games, right? So let's say this insurance company will sell you an insurance product where if a team gets more than 4 goals in a football game, they will pay you out $100, let's say, right? And let's say they sell thousands of these policies to insurance customers, right? Strange company, but let's just go with this example, right? So if you were a reserving actuary or a management team at the insurance company and you wanted to reserve for that, what would you do? Maybe you would look at historical football games and say, like, how many games on average, or like what percentage of games have had more than 4 goals. And so let's say it was 10%, and you said, right, well, if I have to pay out $100 if there's more than 4 goals, then let me reserve $10 right now at the start of this game, because we know from historical data that there is a 10% chance that we have more than 4 goals. But let's say we get to the half-time mark, right? So we get to, let's say in a soccer game, you get to 45 minutes half-time and there have been 0 goals. The question is, should you still be holding $10 of reserves? And of course, no, because it's obvious to see that if you've played half the game and there are no goals, it's less likely that you will have more than 4 goals, right? And this is what we call conditional probability. Let's say we get to the 89th minute and there are no goals. Well, clearly you need less reserves. So in that case, you could release those reserves over time. And if I come back to the board, let's say here you have time, and I hope you can see this, and you have dollars. In a scenario where you have no goals over time, you would obviously do this, right? Your reserves would come down over time. But let's say in a given football game, let's say there happen to be 3 goals. If I just remove this for a second, 3 goals by half time, right? Well, obviously your reserves would go up, and that's all that PPD is. So PPD is just where the insurance company, and I'll do a better video on this, the insurance company just assesses where they are. So if they go like 90% through a customer's policy and they haven't had a claim, clearly it's less likely that they will have a claim. So you release those reserves, and of course we would talk about a group of policyholders. So you've got 1 million policyholders. After 6 months, the group of policyholders has had less claims than you expected. Well, you can release reserves. If they've had more than expected, or those numbers are greater than expected, you would have to increase those reserves. So I'll do a more in-depth video, but just to touch on that, because it is quite an important part of the insurance story. And it is quite interesting to see that sequentially over the last, I think, 5 quarters, there have been positive prior period development releases. So that is quite normal. It's quite typical to see that. Insurance companies would have an initial expected loss ratio, and they would what we call peg the loss ratio at, let's say, 80%. But as the experience comes through, it's better than expected, so release the reserves. So again, I'll do a more in-depth video on that. But overall, this quarter, I have been really encouraged to see all of the numbers that I care about going in the right direction. Gross loss ratio coming down, in-force premium going up. Net cash flow is really good to see that's going up, and it's really cool to see that the cash balance now is 979 million. Like, that's insane. And what I'm really excited about is that, barring potentially Q4 2024, management have made it clear that from Q1 25 onwards, they expect the net cash balance to go up every single quarter. And so you can, if you just forget about profitability for a minute, forget about earnings, forget about all of that, logically, if a business has a growing cash balance every quarter, at some point, you're going to see some of that cash come back as dividends. And that's my whole kind of strategy. Is I've got a pretty good position now in Lemonade, and I'm going to add to it as I can. My plan is just to hold the stock for literally decades and someday to pick up dividends. And I think that one day I will be getting $20 a year dividend from each share. So the price now, I'll get the exact same number back in the future every year in dividends. And Warren Buffett did that with Coca-Cola. He bought the stock in the 80s, and now he gets about 60% dividend yield on cost every single year. So that's my plan. That's what I'm doing with the stock. Encouragement to you guys, if you are holding the stock, just keep holding. Stock will be volatile for the next year or so as we get good earnings, and then people forget the earnings, it will sell off again, and that's my expectation, is to see ups and downs. My strategy is just to hold through all of that. I will sell a little bit if we get a good Q3 rip, because I need some cash for other things to grow my own business. But apart from that, I'm just holding the stock. So enough rambling from me. Happy Investor Day, and I'll catch you on another video very soon. Goodbye.